My next speaker for this morning is Brian Coffey. Brian, welcome, and how are you?
I'm very good, Anil. Thank you for the invitation again. Hard to believe 3 months goes by so quickly.
It is true, it is true. So Brian is a portfolio manager at NS Partners. NS managed the Nedgroup Investments Global Emerging Markets Equity Fund for us. So Brian, it was certainly quite a power-packed quarter and year actually for emerging markets. Can you please talk us through performance to begin?
Sure. Well, a strong quarter for emerging markets, up 10.6% over the past 3 months. That takes the year-to-date performance to 27.5%. The fund lagged in this quarter and is behind year-to-date, but still very strong absolute returns of 9.3 and 23.2% respectively. To put the year-to-date performance for emerging markets in context, emerging markets up 27.5, as I said. Non-US developed markets, so that's mainly Europe, but also Japan and Pacific Basin, are up 26%, so lagging slightly. The world index, which includes the US, was up 17.8%. The US market was up 15%, so a significant outperformance of the US by emerging market assets. And China within emerging markets was up 42% year to date. So some very strong numbers. And, as we have spoken about before, a weak dollar gives a great opportunity for this asset class, which we expect to continue.
Thanks, Brian. Yeah, I definitely want to talk more about the dollar and talk more about China's amazing outperformance as well, but we'll get to that. For now, if you can just please first talk us through how you actually delivered Q3's performance.
Sure. Well, just to kick off, what held us back, the relative performance, if not the absolute performance during the quarter, our stocks in India, Thailand, and Brazil struggled this quarter, as did Greece and Saudi Arabia. And then in the Philippines and South Africa, both securities and our positioning was a drag on relative performance. In terms of what actually didn't work with respect to sectors, our securities and our underweight position in materials, in financials and IT were a drag on performance, and stocks in energy and healthcare also hurt performance. Moving on to what did actually work, so on a more positive tone for the portfolio, the holdings in China and in Hong Kong, so our Chinese exposure via that region, were very positive for performance. Our underweight in India offset some of the impact of the securities in India, and the stock selection in both Korea and Taiwan were positive for relative performance. The underweight in the MENA region in GCC was also a positive contributor, offsetting some of the negative security selection there. And in terms of sectors, what worked for the portfolio was an underweight in consumer staples and in energy, and the stock positioning and our underweight in utilities. So those were the main things that worked. In terms of individual names, as I mentioned, India was the biggest detractor in terms of stocks. So securities that have done very well for us up until now lagged in terms of performance. So Max Healthcare is one of our favorite stocks in India. It reported solid results and it keeps signing new deals in the market, so acquiring new hospitals and expanding with brownfield expansions. But despite that, it's got relatively high valuations, so it's vulnerable to negative sentiment and liquidity shifts. So that impacted Max over the quarter. Indus Towers is an Indian mobile tower company that had a disappointing Q1. So the results were slightly weaker than we had anticipated. But more importantly, for the relative performance of the security was the decision to curtail an anticipated dividend. So they paid out less than expected. And there's a little bit of disappointment with that and concern that they may be looking to do further M&A. Then also in the telecoms area, Bharti Airtel, they gave a soft set of results and missed expectations. And there was slightly higher subscriber churn. But we think, there's been tariff hikes by Bharti Airtel, and that probably lost them some of their lower margin customers. So we're not particularly cured about that. The company continues to post a very strong return on equity of 18% and continues to deliver strong revenue growth. And this is a very consolidated market. There are only 3 players in India in mobile telecoms. On the positive side, so all in China. So we've had the bad all in India, the positive we're all in China. Cattle, which is contemporary Amprex, that's the world's largest battery manufacturer. And that's continued to benefit from strong electricity storage demand. So EVs are growing. That's a big part of the story for batteries, but ESS requirements across the world, but particularly in the US and in Europe, continue to underpin performance there. So we're seeing very strong growth across its markets, and we're continuing to anticipate strong results in Q3 and Q4 for cattle. Then in healthcare in China, Wuxi Biologics, they had FDA approval for 5 of their manufacturing facilities. And so there's lots of positive indicators for future sales there. They gave a positive profit warning. Always nice to get warned that profits are going to be ahead of estimates, but the company did deliver a positive warning for earnings estimates. And we're expecting to see revenues up 16% year on year, despite a 12 to 15% guidance that they gave earlier. So we think that company can continue to surprise positively. And finally, on the individual securities, Futu Holdings, which is the financial services platform, with growing, so this is one of these fintech disruptors, growing brokerage and wealth management services, delivering strong metrics across all divisions. And it's one of these online financial disruptors that has a strong growth amongst lower demographics. So over the quarter, our activity was reasonably high. Given the sharp moves that we saw, I mentioned China was up 42%. We added to our overall exposure in Hong Kong and China, took profits in some names and reinvested in some of the newer names that we have stronger conviction in. We reduced the underweight in Taiwan and also marginally in South Africa. So we added to those markets where we're already underweight and reduced the position there. We increased slightly in Brazil. We took some profits in UAE and trimmed India, and we reduced our ASEAN exposure, and we lowered weights across the 3 markets of Thailand, Philippines, and Indonesia. And at a sector level, we've been adding to IT, communication services, materials, and industrials, while reducing financials, consumer discretionary, and utilities.
Thanks, Brian. It is just interesting listening to you talk about kind of the bad and the good stocks and how sentiment has shifted away from India towards China. And as you mentioned earlier on, the MSCI World Index delivered about 18% for the year, which sounds like a pretty good absolute return until you actually hear, well, China delivered just over 40% for the year. So that happens to be, I think, one of the largest degrees of outperformance that we've seen in years. So I thought it would be interesting to do a bit of a China deep dive for today's discussion. And I guess the first big question I want to ask you, so would you say that China is still attractive from a valuation perspective at the moment?
Well, you probably guessed the answer, Anil, as we've added to exposure in China. So if you look back over the past 2 years, there's been comments on China as in the market has become uninvestable. And that was never our belief. We think China has lots of very attractive companies with very strong growth potential in the coming years. So, there's a strong degree of creative destruction going on in China. There's a lot of competition domestically, which makes their companies amongst the most competitive companies in the world for exports due to that domestic factor. If you look at valuations in China, they have recovered. We maintained our near neutral weighting through that whole period of people saying the market was uninvestable. And if you look at the overall market now, you can see that their market is back to their long-term average valuations. But that includes Chinese state-owned enterprises, which have seen strong support from domestic financial institutions at the behest of the government. So if you look beyond that at quality companies in China, which is obviously the area of the market that we favor, these are way below their even midterm valuations. So they've seen a very strong recovery year to date, but they still remain for us at very attractive valuations.
Thanks, Brian. And I know that you and your team tend to focus on investing in quality companies specifically. So in China, how are those quality companies looking at the moment?
I'm very glad you asked that question, Anil. So yes, we always have had a focus on quality and on growth companies, and that's been particularly the case in China. So, we've discussed the rally in the market driven quite significantly by state-owned enterprises. Those are not attractive to us because generally over time they have destroyed shareholder equity. So they were very, very cheap. They've rebounded strongly, but we don't find those attractive. However, the sort of companies that we like to invest in, high quality companies with strong balance sheets, with good earnings growth, and with strong returns on invested capital, they have rebounded, as we mentioned, from the relative contribution over the past quarter and year to date in China. But they still remain below long-term valuation trends for them. So we think these companies are the best part of the Chinese economy, the best part of the market, and that they deserve to be on higher valuations than we see now. So we're quite happy to continue to add to those.
Thanks, Brian. And I guess specifically then, and you started mentioning some of the kind of good characteristics about these quality companies already, but would you say they're cheap for a reason, or are they like kind of additional positives that the market is not really recognizing as yet?
So the reason for the very low valuations that they got to and that they're now recovering from has been uncertainty about the regulatory backdrop and also about the global trade picture, particularly with the US. But however, if you look at these companies, you can see that their returns on invested capital have been recovering very strongly and continue to deliver positive momentum. We think that those will slow down into the rest of the year, just reflecting the anticipated slowdown we see for the global economy. We don't expect a recession, but our indicators point to a slower global outlook. But these companies will continue to deliver returns on invested capital way above their cost of capital.
I think that's a very good point. I think it's quite a good opportunity now to actually delve into some of the actual companies themselves and specifically what you are finding attractive about them and why.
Sure. So I've got a list of the holdings for the portfolio in China. So these are the names that we prefer in China at present. And what you'll notice as you look at these companies is that they are all delivering very decent EPS growth numbers for 2026. So all positive, all strong. If you look at the most right-hand column, you'll also see that reflecting the quality in these businesses, they don't have stretched balance sheets. By and large, they have cash on their balance sheets. So we've got this very strong earnings growth momentum from companies that deliver improving returns on invested capital. And we're very happy to dig into those. I had mentioned that one of the strong performers was Contemporary Amplex in the last quarter. That's the third stock in the list of names you've got. So that delivered a 10.6% return on invested capital in 2024. That's rising to an anticipated 23% in 2025, and a PE of 22 times, which we think is pretty good given a 20% EPS growth anticipated for 2026. And that company has net cash. It's raising some money in Hong Kong and some debt they've raised in Hong Kong, and that money will be used to finance international expansion. Alibaba is another company which we have held throughout the past 2 years. You can see that that company has rebounded from a ROIC of 6% last year when we saw strong competition in the e-commerce parts of the market in China. However, that has diminished, and we're now anticipating an ROE of 13% for 2025 and rising into next year. So we've got a negative EPS growth for 2026 on Alibaba, but that reflects the beginning of a strong AI investment. So Alibaba is one of the AI platforms, so they're going to provide AI services for the Chinese artificial intelligence push. And again, this is a company with net cash. So we're very excited about that. Alibaba itself was up 42% in Q3 alone, and we still think it remains very attractive. I can run through every stock on this name, but the key thing for me is that if you look at the second and most right-hand column, that you've got companies delivering good earnings growth for reasonable valuations, and that most of these companies have little or zero debt on their balance sheets. So we're very happy to. And the reason that these companies have become so attractive was the exodus of foreign investors from China. And that left bargains in almost every sector. But, as I say, these are well-run companies. They're growing, no debt, and some of them are buying back shares. So by and large, these are private sector companies.
Thanks, Brian. Yeah, literally no shortage of good reasons to invest and good opportunities there. Brian, before we close off, I just wanted to get your thoughts on the US dollar, please. I mean, as we know, the dollar is very important for emerging markets. Can you just please share your latest thoughts around this?
It's the graveyard for all economic predictions is calling currencies. So, there's always room for volatility in the near term. We've seen some weakness in the US dollar. So if you look at the charts that we have on the presentation right now, in the right-hand chart, you can see the relative performance of emerging markets to the US during periods of dollar weakness. And you can see that during the most recent period of dollar weakness, they continued to lag the US market. And only very recently are we starting to see a rebound in emerging markets on a relative basis. So, we think the year-to-date number for emerging markets is very positive, plus 27% versus plus 15% for the US. But that's after significant underperformance of the world index. If you look at the chart on the left-hand side, you can see, that we're at a point where typically we would expect the dollar to continue to weaken, and it coincides with the housing cycle lows. And our anticipation is that we should see weaker housing markets in the US until 2027, and that will be reflected with a lower US dollar.
Thanks, Brian. And can you please conclude today's chat by just maybe talking through your outlook for markets, as well as some of the key regions that are top of mind for you and the team?
Sure. Well, the thing that we're most positive about is emerging markets in general. As I say, they've only just started to recover from an extended 15-year period of relative underperformance. And it's a similar story with the US dollar. It's just starting to weaken, in our view, after sustained significant outperformance. Money trends globally and the stock building cycle suggest that we'll have an economic downswing from late in this year. So we actually think it will show up in the numbers in Q4, but we probably won't see confirmation of that until early 2026. However, we're not calling for any sort of recession at this stage. The indicators that we're looking at point to a softening in economic growth globally. Monetary backdrop is not supportive of price increases, so it's deflationary globally. So we think that means that there will be room for policy response to that softening global outlook. Treasury yields on US dollars, not surprisingly, we expect those to continue to decline. We think money in China, so money growth in China, it continues to slow, but it's relatively supportive. And again, with China, we think the trade negotiations are the reason why they're not priming their economy further than they have to date. We think the Chinese real exchange rate is too low and that it will appreciate, and that will help correct the trade surplus. And that correction in the trade surplus, again, actually, will result in less buying of US dollars by China, which is not supportive of the dollar. Money trends are favorable in India, but they're weaker in Korea and Mexico. So we're zero-weighted in Mexico, and we've been underweight in Korea. We're starting to rebuild positions in India. We're cautious on that cyclical outlook, and as a result of that, we remain less inclined to buy more cyclically exposed economies or sectors. So we're underweight materials selectively. We're underweight key parts of the industrials, and we will continue to reflect that. And we have a preference for markets insulated by decent domestic demand or from policy easing. So, we think there's places with very high real interest rates amongst the emerging markets. Brazil is one of them. It's complicated by the political backdrop, but we think that will work out in their favor. We think some of the ASEAN markets will benefit from policy easing, although, again, politics have intervened there. But the key for us is domestic demand. We think China and India can both deliver decent domestic demand. And so we'd be looking to be overweight both of those markets as we move further on into the year and indeed into 26.
Brian, thanks very much. It's been very insightful speaking to you this morning, and we really appreciate having you here. So thanks so much for making the time.
Great. Thank you very much for the opportunity, Anil. I look forward to speaking to you next quarter.
Most certainly. Thanks then. Bye-bye.
Bye.